Marine insurance was established in the 17th century to secure international trade, as water was the main means of bulk transportation then. Since then, marine insurance has grown into a number of small factions, among them cargo insurance, freight insurance, hull insurance, and stevedores. Hull insurance covers the ship, while cargo insurance covers the goods. Freight insurance covers the leaser of the ship, and stevedores the crew. To break it down into a local scenario situation, everything is insured separately. And was the ship a matatu?
Simplest example is the matatu industry. Matatus are owned by somebody else. They are leased out to somebody else to drive and earn money. It's given on a daily basis or a weekly basis or a monthly basis. The person who uses that matatu for earning freight, he pays a fixed amount to the matatu owner. He makes his money from carrying the people. The people who are carried are just like the cargoes.
Of concern though for any exporter and importer is the cargo insurance that protect wares on the ship from vandalism, damage, and spoilage for perishable goods. Of notice though is the knowledge that none of the insurance will cover for delays in getting the wares to the port. In international maritime law, of all the inhabitants of the vessel, first priority is given to the crew, secondly to the ship, and lastly the cargo. And should there be a need for evacuation?
Luckily for cargo owners, the perils of sea, which includes typhoon, cyclone, tempest, are covered under the normal cargo policies. But the perils like war is an additional peril which is to be paid additionally and covered separately. And the perils of piracy also are becoming very important nowadays.
Sadly though, not many importers are aware of the risk that their goods face, with only about 10% of all imports and exports being insured. This is half of the global average, which stands at 20%. In more developed countries where the international trade is carried out through the banking sector, this kind of insurance averages at about 30% of the national insurance earnings in countries like the United Kingdom, Japan, and the United States of America. Iyer thus blames the low penetration of this insurance locally on over-reliance on cash, exposing traders to losses and government to reduce revenue.
Most of the trade is done on cash and there is no banking channels, whereas in banking channels mostly the insurance is compulsory. So most of the trade done on cash basis, many times the traders do not do insurance.
He says this form of insurance has the potential to double with increased public awareness. However, this insurance has been victim to insecurity at the sea, which has seen premiums double in the last 3 years, even as international navies increase presence in the Indian Ocean near the Horn of Africa. Overall, there is a general consensus that there is a huge potential for growth of this form of insurance, especially Kenya being a net importer.
With the potential which Kenya is showing in terms of its import dependence and export dependence, I think there's a huge potential for the marine business to grow exponentially, because we can be a hub for not only Kenya but also the entire East and Central Africa.
Kama Umbote, Channel 1 Bizweek.